It happened again. In the middle of the night, precisely when liquidity was thinnest, the hammer dropped. The spot price didn't just slide, it was violently slammed down. The trigger? A sudden, unannounced margin hike by the CME. Not a subtle adjustment. A kinetic weapon deployed against momentum. Positions were liquidated instantly. Stops were hunted. And just like that, the breakout was decapitated. If you think this is standard market volatility, you are blind to the mechanics. This wasn't a correction. This was an engineered collapse designed to shake you out of your position. Welcome back. We need to talk about what happened in the futures market 4 hours ago, because if you look at the mainstream financial headlines, they are lying to you. They are telling you this is profit-taking. They are telling you that silver lost its luster due to interest rate expectations. That is noise. I am going to show you the signal. I was watching the order book when this happened. Silver was pushing against a critical resistance level. The volume was building. The shorts were sweating. You could see the pressure building in the open interest. And then, out of nowhere, the notification hit. The Chicago Mercantile Exchange, the entity that controls the rules of the paper casino, raised the margin requirements for silver futures contracts. For those new to this, margin is the collateral traders must put up to hold a position. When you raise that requirement abruptly, you force leverage traders to do one of two things: deposit millions of dollars in cash instantly or sell. Most can't raise the cash, so the algorithms automatically sell. It creates a cascade, a domino effect of forced selling that has nothing to do with the value of silver and everything to do with the mechanics of the exchange. I've been tracking these anomalies for years, and the timing of this specific spike is too precise to be accidental. It was a circuit breaker pulled on purpose. Let's break down exactly how this mechanic works, because you need to understand the weapon being used against you. This is not supply and demand. This is administrative violence. Imagine you are buying a house, but you only have to put down a 5% deposit. The value of the house goes up, and you're making money. Suddenly the bank calls you and says, the rules have changed. In the next 10 minutes, we need a 20% deposit, or we take the house and sell it at whatever price we can get. That is what the CME just did to the silver market. When the price of silver starts to run, when it starts to threaten the naked short positions held by the bullion banks, the volatility increases. The CME cites this volatility as the excuse to raise margins. They claim it is to ensure market stability. But look at the effect. Who holds the massive long positions? Often, it's the speculators, the hedge funds, the managed money who are chasing the trend. They are highly leveraged. When the margin requirement spikes, they are the ones who get the call. They are the ones forced to liquidate. And who is on the other side of that trade? Who holds the massive short positions? The commercial banks, the entities that need the price to go down to cover their shorts profitably. When the margin hike triggers that forced selling, the price crashes. This allows the commercial banks, the smart money, to cover their short positions at lower prices. They effectively use the rulebook to bail themselves out of a bad trade. I looked at the transaction data from the moment the hike was implemented. The speed of the sell orders indicates algorithmic trading. These weren't humans making rational decisions to sell physical metal. These were computers executing sell-at-market orders because their collateral ratios were blown up by a rule change. This creates a self-fulfilling prophecy. The margin hike causes the drop. The drop causes panic. The panic causes more selling. And suddenly, a legitimate rally based on physical shortage is wiped out on the paper chart. It is a feature of the system, not a bug. They want you to look at that red candle and think, oh no, silver is crashing, I better sell my physical stack. They want to break your psychology. But here is where their game falls apart. Here is where the narrative creates a glitch in the matrix that they cannot hide. While the paper price was plummeting on the COMEX, I did something the algorithms don't do. I picked up the phone. I looked at the physical inventory of the 3 largest bullion dealers in the United States. If silver was truly crashing, if nobody wanted it, if the market was flooded with sellers, you would expect to see inventory piling up. You would expect premiums to vanish. You would expect dealers to be slashing prices to move metal. Here's what I found instead. At the exact moment the paper price dropped 4%, the premiums on physical silver eagles did not move. In fact, on 2 major wholesale exchanges, the bid price for physical delivery increased. Do you understand the significance of that divergence? The spot price, the number you see on the ticker, claims silver is worth less today than it was yesterday. But the real market, the market where metal actually changes hands, is screaming that silver is scarce. I am seeing reports of delivery delays extending out 4 to 6 weeks for certain mint products. I am seeing sovereign mints canceling allocations to dealers. We are witnessing a bifurcation of reality. There is the paper price, which is determined by leverage and margin rules on the CME. And then there is the physical price, which is determined by the fact that you cannot print an ounce of silver. When a margin spike happens, it creates a discount for the physical buyer, but only if you are quick enough. The dealers know the game. They know the spot price is fake. That is why the spread between spot and physical widens during these crashes. The paper market is trading 400 ounces of paper silver for every 1 ounce of physical silver in the registered vaults. Think about that ratio. 400 to 1. The entire pricing mechanism relies on the assumption that 399 of those people will never ask for delivery. But what I am seeing in the delivery data suggests that confidence is breaking. More traders are standing for delivery, and when the CME raises margins, it is an act of desperation. It is an attempt to flush out the paper holders so that the exchange doesn't default on the physical metal. They are shaking the tree to see who falls out because they know they don't have enough apples for everyone standing underneath it. If this feels familiar, it's because we have been here before. This is a playbook that has been used in every major precious metals bull market in history. Go back to 1980. The Hunt brothers. Silver was rocketing toward $50. It was an unstoppable force. The exchanges didn't just raise margins. They changed the rules so that you could only place liquidation orders. You literally were not allowed to buy, only to sell. They destroyed the market to save the banks. Look at May 2011. Silver touched $49. The momentum was vertical. The dollar was weak. Then, over a span of 2 weeks, margin requirements were raised 5 separate times. 5 times. They kept hiking the cost of holding the position until the long traders broke. The price collapsed from $40 down to $33 in days. They are running the 2011 script right now. But there's a critical difference between 2011 and today. In 2011, we did not have the supply deficits we have today. In 2011, there was plenty of silver in the vaults. Today, the COMEX registered inventory, the silver actually available for delivery, has been drained by nearly 70% over the last 3 years. In 2011, solar demand was a fraction of what it is now. Today, the industrial complex is devouring silver faster than miners can pull it out of the ground. So, while the tactic is the same, raise margins, force liquidation, the environment has changed. They are trying to suppress the price of a strategic asset that is in a structural deficit. This is like trying to hold a beach ball underwater. The deeper you push it, the more pressure builds up. When they triggered this sell-off, they bought themselves time, maybe a week, maybe a month. But they did not solve the problem. They made the problem worse because low prices discourage mining and encourage industrial consumption. They are effectively subsidizing the destruction of their own inventory. So what happens next? Short term, expect volatility. The technical damage on the charts will invite more algorithmic selling. The dumb money will panic and sell at the bottom. The mainstream media will write obituaries for the silver squeeze. But watch what the whales do. Watch the Shanghai Gold Exchange, where silver is trading at a massive premium to the West. The East is using these paper dips to drain the West of physical metal. While New York traders sell paper contracts because the margin is too high, Shanghai traders are taking delivery of physical bars. We are approaching a breaking point. The margin spike is not a sign of strength from the establishment. It is a sign of weakness. It shows they are terrified of the price taking out the $35 or $50 level. They know that once those levels breach, the FOMO, fear of missing out, will be too great to contain with margin hikes. Here is my strategy. I do not give financial advice, but I tell you what I am doing. I am ignoring the red candles. I am ignoring the CME notifications. I am looking at the physical ounces in my possession. When they smash the price, they are putting silver on sale. They are transferring wealth from the leveraged speculator to the patient accumulator. This event, this margin spike, is a gift. It is one last chance to exchange failing fiat currency for real money at a suppressed price. But the window is closing, the inventory is thinning, and the next time they pull this lever, it might not work. The lever might snap. Stay skeptical, stay liquid, and most importantly, keep stacking. I'll see you in the next one.